You are currently paying off the United States government's $39 trillion debt. You didn't agree to it, and probably don't even realize it's happening. This scale shows the basic math of the US budget. The government brings in about $2 trillion a year from taxes, but it spends $4 trillion. On top of that, the annual interest required just to service their existing mountain of debt sits at roughly $1 trillion. That leaves a massive $3 trillion hole. Every single year, the government needs to borrow $3 trillion just to keep the lights on, the military funded, and the system running. Who has that kind of money to lend? Japan, the UK, and China are the three largest foreign creditors to the United States. Combined, they have lent less than $3 trillion over the past several decades. Absolutely nobody on the open market has $3 trillion in spare liquidity to lend the US every 12 months. So the Federal Reserve simply prints it out of thin air and lends it directly to the US Treasury. But there is a mathematical catch. Every time the Fed prints a new dollar, the purchasing power of the dollars already sitting in your bank account decreases. When the dollars in your wallet lose value, your wealth is quietly transferred to the government. The national debt shrinks in real terms, and you foot the bill. Inflation is a systematic, hidden tax designed to fund the state at your expense. If a central bank prints money endlessly, the currency usually becomes worthless. Citizens end up needing trillions of dollars just to buy a single loaf of bread, which is exactly what happened to the economy in Zimbabwe. To prevent immediate hyperinflation in the consumer market, the Federal Reserve created holding tanks for all this new cash. The first is the stock market. When the Fed prints money, it goes directly to financial institutions, who use that cheap capital to buy back corporate shares. This drives asset prices higher while keeping the newly printed money out of the grocery store. This diagram shows the flow of that capital. The second holding tank is a mechanism called overnight reverse repos. The Federal Reserve tells commercial banks they can park their excess cash in the Fed's own accounts in exchange for a high, risk-free interest payment. Banks eagerly transferred their cash out of the real economy and back to the central bank. At its peak, this pool swelled to over $2.5 trillion, successfully freezing that money and keeping it out of active circulation. Once the money is trapped, the Fed initiates the second phase. They raise interest rates and shrink their balance sheet, withdrawing older currency from the system. This chokes off the global money supply, causing the US dollar to artificially appreciate in value. The government gets its funding, the stock market inflates, and the dollar remains strong on the global stage. These financial reservoirs create an illusion of economic stability, successfully masking the continuous debasement of your savings. Because global commodities like oil are priced exclusively in US dollars, foreign nations are trapped in this cycle. If energy prices rise, every country suddenly needs more dollars just to keep their factories running. To acquire those necessary dollars, foreign governments have to print their own domestic currency and exchange it on the open market. They actively dilute their own citizens' savings to purchase the dollars needed for energy, subsidizing the American system. This gauge tracks the emergency liquidity left in the Federal Reserve's overnight reverse repo pool. Over the last few years, the Fed slowly released that trapped cash to keep the system running while they tightened the economy. But now, that pool is completely empty. With no emergency cash left to absorb the shock, the Fed's ongoing policy of dumping treasury bonds is crashing the bond market. Buyers have vanished, and the government's borrowing costs are spiking to unsustainable levels. The central bank is caught. If they continue to tighten the money supply, the entire financial plumbing freezes. If they pivot and start printing money to buy their own debt, the dollar will plummet. The mechanisms used to manage liquidity for years have reached a mathematical limit. The Federal Reserve is now out of emergency reserves, making a major pivot in the global financial system inevitable. The newly confirmed Federal Reserve Chairman, Kevin Warsh, has a controversial strategy to force a solution. His immediate target is a massive vault of capital. Right now, commercial banks hold roughly $3.1 trillion in excess reserves. That cash sits perfectly idle at the Federal Reserve, earning commercial banks over $100 billion a year in risk-free interest. Chairman Warsh intends to abolish that interest payment. When the Fed stops paying banks to keep their cash locked up in a vault, those institutions will immediately withdraw that $3.1 trillion and look to lend it out to the private sector to generate yield. This diagram maps the fractional reserve banking multiplier. When that initial $3.1 trillion is unleashed, banks will lend it to businesses, who pay workers, who deposit it back into banks, to be lent out again. Economists estimate this cycle will rapidly expand that capital into over $12 trillion of active liquidity. That $12 trillion flood will bypass everyday wages and flow straight into premium assets, stocks, real estate, gold, and Bitcoin, driving their prices aggressively upward. If your savings remain in cash when this wave hits, your purchasing power will drop in direct proportion to the expansion of the money supply. Your wealth is essentially being recycled to pay off the national debt. Protecting your capital through this shift demands a transition from emotional guessing to a disciplined, systematic investment approach. You must replace rumors and headlines with cold, structural rules. That is exactly why we created the Stewardship Finance Academy free stock investment masterclass. We provide the institutional-grade framework you need to systematically protect your capital and actually multiply it during this specific macroeconomic shock. We are planning to transition this training to a fully paid program very soon. To secure your free spot before that happens, click the very first link in the description below right now. Before we wrap up, I want to take a moment to address our community directly. During our recent channel hiatus, I saw nothing but incredible support and encouragement in the comments. Your trust means everything, and I am fully committed to bringing you the highest quality financial education possible. If you found value in this breakdown, subscribe, hit the notification bell, and share this video with someone who needs to hear it. Learn the rules of the system, position your capital, and protect your wealth. See you in the next video.